Let's talk a little bit about your forecast, which I think may be what is causing the stock to stumble a little bit today. You've been working through a choppy macroeconomic backdrop. Explain why that is when a lot of the measures of the economic landscape are pretty positive right now, except for inflation, I suppose, which is sticky.
Yeah, I think if you go back and look at retail performance in Q4 this year, I think a lot of retailers saw a choppy environment. Customers under pressure, credit card debt's at a pretty high level right now. Inflation's still pretty high. So I think the combination of those two has made the consumer a little more cautious. We were happy with our results in Q4 in terms of improving. But we see the customer still being under pressure, and we think that's going to continue at least into the first quarter of this year.
And so you brought down your estimates below where the FactSet forecasts are. Is that a case of wanting to underpromise and then overdeliver, or is it a reflection of what you see in the business environment, or a little bit of both?
I think it's a little bit of both. I mean, I think obviously one of our goals is to give the best guidance we can give out there in terms of accuracy, and that's what we tried to do. I think it accounts for kind of a continuation on the low end of the current trends we're seeing. It certainly implies that we could see the business inflect more positively as we progress through the year, and that's what we really tried to indicate in our guidance.
Are there particular categories of sales within your enterprise that are weaker than others? And if so, what would your hypothesis be behind why that is?
Well, we've seen some increases in some of the categories that have been lags for us, like our outdoor area. That business was certainly good for Q4. Where we continue to see some weakness are in some of these long lead time replacement cycle businesses, like fitness equipment is one. Obviously, if you bought a treadmill during the pandemic, you probably don't need to buy another treadmill, and that continues to be a bit of a soft spot. So those are some of the softer categories for us.
That's an interesting point. I mean, that might be a residue or a hangover from the, as you say, the pandemic, when people rushed out. They came in, they bought the fitness equipment, whatever it is, the home gym stuff, and now they just don't need to replace it. Interesting point. So let's talk about store openings over the next couple of years. You have a rather aggressive rollout here. Will most of those stores be in your traditional sort of regional footprint or geographic footprint, I should say, or will you be expanding that geographical footprint out of your traditional in the South areas?
It's a really good question. So we updated our new store guidance. Previously, we'd guided 120 to 140 new stores over the next 5 years. We've increased that to 160 to 180. We're looking at a better balance going forward. So about half of those will open up within our existing footprint. We have high brand awareness. Half will be in new markets. One of the things is we've opened up about 23 stores over the past couple of years. We found that when we go into new markets, if we can have more density as we go into a new market, that's going to help see us cluster more stores as we enter new markets. So it's more of a refinement of the strategy that we rolled out about a year ago. Versus a wholesale change, but more stores, better balance across the geography, and maybe some more mid-sized markets we're going to look at as well.